Hello everyone, we are Group 1 and today we'll present about investment portfolio. Our presentation consists of four main parts. The first one will be 10 chosen firms in our watch list. The second is market portfolio. The third will be the crypto portfolio and the final one is minimum risk portfolio. Moving to the first firm, Kotecon Construction Joint Stock Company, established in 2004 and officially listed under the stock ticker CTD on Jose in early 2010. Kotecon Group has grown successfully and become the first position in the top 10 most reputable construction contractor owned by Vietnam reports. Its main business line is construction houses of owned cars and residential buildings. Contecon was put under pressure during the past year. However, we still put steadily on our watch list because of long-term investment. The first one will be the high value of new contracts. In 2021, Contecon backlog reached 24 trillion VND, and in the first quarter of 2022, the new contract value reached 10 trillion VND, and this is expected to stimulate the company growth, revenue, and profit in the near future. The second will be the slowly moving toward infrastructure construction segments. CDD will aim to build projects such as data centers, railway stations, and airports, and this field is new, has high technical requirement. However, with a positive outlook for government investment and the existing advantage of having built many large projects, these are planned to make a significant contribution to the company profit margin in the long term. In terms of the return and risk, overall investing in CDD generated a negative yearly return around minus 24.65%, and CDD has the second highest risk among the 10 firms. 39.97%, and the reason is that the COVID-19 pandemic had halted the construction activities and rose building material prices, putting construction enterprises into difficulties. However, we still include CDD in our watch list because in the next 3 to 5 years, public investment have been projected to have a special intention from the government to stimulate the growth and recover the economy after COVID-19. In the construction industry, compared to HPC and CAI, CTD produced the lowest yearly return. However, CTD has a lower stock dispersion and considered to be more stable and less volatile. To the second firm, FPT Corporation, established in 1988 and officially listed on Jose under the stock ticker symbol FPT in 2006. FPT has grown to become the largest ICT company in the private sector in Vietnam, and the core business of the corporation focuses on three sectors: technology, telecommunications, and education. Business prospect of the FPT is that the first one will be digital transformation. In the post-COVID-19 era, the demand for high technology is increasingly rapidly. In FPT core and high-performance technology segment, the main driver of company growth as its revenue reached 5.59 trillion VND, and the Make by FPT world-class ecosystem with a revenue growth rate of 42.8% in 2021 is regarded as one of FPT's primary long-term development drivers. And the second is the demand for IT employees will lead to the development of FPT education segment. Vietnam is facing a shortage of IT human resources, and it will seize the opportunities for FPT education to grow positively. In 2022, FPT continued to invest more than 8 billion VND, expanding educational campuses in 8 new provinces, and it is expected to attract more students, and this segment revenue will continue to increase by an average of 30% per year. And in terms of the returning risk, the average yearly return of FPT is about 28.69%, which is one of the highest return among the 10 chosen firms, and FPT has the lowest dispersion, with an average annual standard deviation of 28.18%, and carry a lower risk than investing in on other companies. The reason is in COVID-19, there's a huge demand for digital transformation, and telecommunication, software expert service, and education all have strong development over the period. In the technology industry compared to ELC and CMG, regarding the annual expected return, everything completely outperformed ELC and was a little bit lower than CMG. However, the standard deviations of ELC and CMG are higher, suggesting more fluctuation from the average return, and hence is considered to be more volatile.
The next firm is MWG Mobile World Investment Corporation. It was first established in March 2004, then listed on Host 10 years later, in July 2014. The company's core business line includes retail of digital products, retail of electrical products, grocery store, and pharmacies. MWG achieved the top 50 best list company in Asia according to Forbes magazine, and by far one of the fastest growing company in Vietnam. The first reason to choose MWG is its rapid increase in number of stores. In just 5 years, MWG number of stores increased by about 3,300 stores. This rapid brings brand awareness. One of the key reasons makes MWG currently the number one retailer in Vietnam in terms of revenue and profits. Second reason is the expansions in pharmaceutical retail segment. Starting from only 7 stores in 2018, is MWG now expectation to reach 800 stores by the end of 2022 and 2,000 stores by the end of 2023. In the situations where everyone understands the importance of health, this expect to receive great responses from the public, potentially bringing back large contribution to revenue in the future. MWG yearly average return is about 11%, ranking 6th in our watch list. The risk of investing is about 37%, placed in the fourth positions. MWG return and risk rate are not too outstanding. This might be due to the COVID-19 disease and inflation. Because of COVID, customer incentive to go shopping outside is reduced. Inflation also makes customers be more aware about their consumption. As a result, MWG's strategy did not fully reach its potential, but costs along high costs. For peer comparison, we choose FPT, DGW compared to its competitor. MWG has the lowest return and an average risk rate. The next company is SSI Security Corporation. It was first established in December 1999, one of the oldest companies in Vietnam stock market, listed on Hack and East in 2007. SSI core business line include security services, investment banking, treasury, principal investment, and assets management. Some of SSI outstanding achievements are Best Security House in Vietnam by Asia Money, and Best Equity Advisor by the Assets. The first reason to choose SSI is 2021 strong positive business results. Compared to last year, SSI net revenue increased up to 72%. The company profit before tax also shown an impressive growth, exceeding 60% of the year plan. SSI marginal balance accounts for 24% of the whole market, the highest in the market. The second reason is SSI market share. In the first quarter of 2022, SSI market share accounts for 9.66%, ranking in the second position. Based on large achievements in marginal balance, SSI market share is expected to increase by 0.6% at the end of this year. SSI yearly average return is about 8% and risk is about 41% in the last 5 years. The return rate is ranked 8 in a watch list and has the highest risk rate among all the 10 firms. This might be due to global political situations and COVID-19 outbreaks. Political events can have major impact on the stock markets. However, a new disease increased worries and concern. Investors would prefer to keep more cash, therefore withdrawing their money out of the stock market, affecting all security companies. To compare SSI to the industry, we choose BPS, HCM, VCI, MBS, and BPS. Compared to other firms, SSI is actually doing not that bad, having the lowest risk and ranked fourth in terms of revenue, best among its competitors.
ABG Hoffa Group, founded in 1992 and listed on Host in 2007, ABG has earned many achievements in its main business of steel production, the most prominent of which is the largest steel producer in Southeast Asia. The reasons to choose ABG are, firstly, global steel demand, excluding China, increased while China restricted steel production by domestic enterprises, giving Hoffa a chance to increase export outputs. Secondly, orders from traditional markets continue to increase steadily. Finally, steel consumption is having a significant recovery, especially the sources of consumption come from the southern markets. The North-South Highway ACES project also contributes largely to the demand. About return and risk, from 2017 to 2022, ABG has an average annual return of about 19%, which is the second highest on our watch list. And ABG's annual standard deviation is about 34%. The return is so high, but their standard deviation is only around fifth. Those can be explained. Yungwook 2 project is expected to start construction. COVID-19 outbreak caused the price of input material to rise. Steel imports from China at cheap price are greatly affecting domestic consumption. We compare HBG, HSG, NKG, and POM. NBG show a significantly positive performance when average annual return led on with a huge difference, higher than the average of 4 companies. NBG, meanwhile, was the safest stock with the lowest standard deviation, well below the 4 company average. So, MBB, Military Joint Stock Commercial Bank, founded in 1994 and listed on Host in 2001, MB is a business enterprise mainly in banking and financial services. One of MBB's many achievements is the top 40 most valuable brand in Vietnam in 2018. The reason to choose MBB are, firstly, 2 reasons for MB increase their credit limit. MB has good financial quality and the possibility of MB participating in Ocean Bank restructuring. Secondly, MB's pushing for digital transformation attracts more customers, improve the ability to mobilize CISA non-term deposits, and reduce CIA costs. Thirdly, MB is currently one of the banks with the lowest bad debt ratios, but MB is still one of the 2 banks with the highest debt coverage rate. A large provision in 2021 will provide a solid foundation for growth. About return and risk, from 2017 to 2022, MBB has an average annual return of about 17%, the 4th highest in our checklist, while the standard deviation was impressive with 7th place, about 34%. Those can be explained superior risk management and advanced operation and development strategy for the periods 2017 to 2021, overcome the effects of the COVID-19 pandemic, adapting to the focus of digital transformation and saving costs. We compare MBB, CTG, VCB, BID, and ACB. Both MBB's average annual return and standard deviation rank third. The average annual return show positive side when outperforming the average of 5 companies, as well as the MBB's risk level was less than the average of 5 companies. CTG, Vietnam Joint Stock Commercial Bank for Industry and Trade, founded in 1988 and listed on Host in 2009. Vietinbank is known as a banking and financial services business. CTG has earned many achievements, notably the top 300 most valuable banking brands in the world. The reason to choose CTG are, firstly, Vietinbank having addressed the need to increase capital to get a higher credit limit from the state bank, can be expected that CTG's credit growth will be more positive in the coming period. Secondly, it is expected to complete the procedure of transferring exclusive insurance partners by the end of 2021, early 2022. Thirdly, Vietinbank currently continue to implement the roadmap of divestment in its subsidiaries in order to increase the equity of the parent bank to invest in more appropriate strategies. Finally, Vietinbank's NIM is expected to increase and remain above 3% in the future, as income is expected to increase sharply after COVID-19. About return and risk, from 2017 to 2022, CTG has an average annual return of about 12%, and CTG's annual standard deviation is 38%. CTG's performance is mediocre on our watch list because CTG's average annual return is only modestly ranked 6th, while taking many risks when there is a standard deviation ranked 3rd. Those can be explained. Credit risk provision expenses increased more than 3 times, causing Vietinbank's profit before tax in the first quarter of 2022 to decline. In 2021, CTG cut more than 7,000 billion VND in profit because of reduced lending interest rate, fees, and divestment. We compare CTG with VCB, BID, MBB, and ACB. Among these competitors, CTG's return is lowest but carry many risks. Its standard deviation ranks 2nd.
And the next firm that we choose is Vietcombank. It was established on the April 1st, 1963 and listed on wholesale on June 30, 2009. Its core business is finance and banking, and it have some achievement is have many times rated as the best bank in Vietnam by global organizations, and it's make major contribution to the national economic stability and growth. Turn to its business prospect. It's a price business picture in the 5-year period. Its total operating income in 2021 is more than 50,000 billions and increased 48.1% compared to 2017. And the profit after tax is increased 58.4% between 2017 and 2021. Especially, VCB could keep the business stable during the COVID-19 period. And it's recognized as the biggest bank in Vietnam, rated by the many organizations like the Asian Bankers and Forbes, and it's the 4 pillars in finance and banking industry. Turn to the return and risk. Vietcombank had the third highest return and the third lowest risk. The reason for this is have the large market capitalizations, and Vietcombank is the largest in the banking system, and it is a leader in digitalizations, make breakthroughs in digital banking operations and becoming a banking digitalization model, and it also have a high credit quality. Turn to the peer comparison. Vietcombank compare with top 5 firm in terms of capitalizations, and Vietcombank have a very high expected return and also the lowest risk in this industry. The next firm is Vingroup. It was founded on August 8, 1993. Its precursor was Technocom, and it was listed on wholesale in 2007. The core business is technology, industrial services, and social enterprises, and is the now Vietnam largest non-state-owned enterprise. Turn to the business prospect. Vingroup has a significantly high year-to-year net income. In 2017, it's nearly 19 billion and more than 410,000 billion in the following years. The profit after tax is increased 43.6% from 2017 to 2021. Although COVID-19 make VIC business slightly decrease, it's a time for VIC to change. And the next reason we choose is that Vingroup has the ambitions to bring a Vietnamese brand to the world, and is make a lot of investment in VinFast to do this. And VinFast have an aim to launch a complete range of electric vehicles in the international market in the first quarter of 2022. Turn to the risk and return. VIC have the 5th highest return in our watch list and the 2nd lowest risk. The reason for this is Vingroup has an ambitious and taken action to bring a Vietnamese brand to the world, so they gain trust of investors, and bring home not rapid but consistent expansion in the extremely competitive real estate industry. Because VIC main business is real estate, so we compare with the real estate company. So as you can see, VIC have a quite high return. However, the risk is VIC is also lower than the other firm in the industry. The next firm that we choose is Petrolimex. It was established on 12th January 1956, and it was first listed on Ho Chi Minh City Stock Exchange on 21st April 2017. The core business is petroleum, petrochemical, gas, and project or businesses related to petrol. The achievement is one of the largest corporations in Vietnam, leading the petroleum downstream business, and the listed company with the highest revenue in the stock market, marked by Forbes. For the business prospect, the Petrolimex brand is well known in both domestic and international market. It owns the largest technical infrastructure among the petroleum key traders, and Petrolimex strategic partner is ENEOS, the #1 energy corporation in Japan, and it has the potential to grow stronger in the future as the demand for petroleum will increase. Turn to the return and risk. It had the 2nd lowest return in our watch list and the 6th highest risk. The reason for this is the severe impact of COVID-19, make the demand for petroleum decrease due to the trade tensions and lockdowns, and the unpredictable world price. It will affect the input price of the petroleum enterprises. Turn to the peer comparisons between the 2 companies, which is PD and PVI. In this peer comparison, Petrolimex have a very low expected return and also have a quite high risk in this industry.
Now we'll talk about the average annual return, the risk, and the beta of the market. The market portfolio and annual average return from 2017 to 2022 is 7.71%. Its rate is smaller than most rate in our watch list. It's only higher than the rate of the CTD and PLH, which have negative figures. And this is the low rate. It's the low rate, and there are 2 reasons for this. The COVID pandemic, which negatively affected business performance of many firms, and the conflict between Russia and Ukraine, which resulted in the fluctuation of the global market. And the Vietnam stock market has moved downward due to these two reasons. For the annual standard deviation of the market portfolio during this period is 19.8%, suggesting that the annual average return deviated by 19.8% every year from the annual average return. While the market portfolio standard deviation is the smallest when compared to the other standard deviation in our watch list, this rate is still high. This can be attributed to the fact that during this period, the Vietnam stock market is highly volatile since many instability events such as the Brexit phenomenon or the emergence of the COVID pandemic. Some events have driven both domestic and international investors to actively withdraw their cash, resulting in a difficult period for the Vietnam stock market. And for the beta, because beta related to the responsiveness of a security to the market portfolio, it means that the beta for the market portfolio is 1.
For this part, I will present how the decision was made for the portfolio. As a common sense of pragmatic investors, we would expect to earn the highest return with the lowest risk as possible. So it's our philosophy, low risk, high return. As we plotted 10 stocks on a risk return chart, we noticed that there were 5 stocks, FPT, VIC, VCB, MEB, and HBG, that stood out to adequately match our established standards. Additionally, the 5 chosen stocks all lie in the efficient set within the chart and have relatively healthy risk among the watch list. Eventually, we assume that these 5 stocks were equally financed with 200 million VND distributed to each stock. This means that each of these stocks in this case makes up 20% of our portfolio. Next, technically speaking, I will demonstrate how we got the result for the portfolio's return, risk, and beta coefficient. Our portfolio expected yearly return is simply a weighted average of the expected yearly returns on the 5 individual securities in the portfolio. Then, for the portfolio standard deviation or the total risk, we use the matrix method to calculate the yearly standard deviation of the portfolio, wherein covariance among the portfolio's individual stocks is taken into account. To begin, data analysis in Excel is used to calculate the covariances between each possible pair matched from the 5 stocks in our portfolio. Then, blind cells are plucked by the covariance from the respective transposition pairs to yield the complete matrix. Then, we use the MMULT function to obtain the product of the 2 matrices in accordance with the principal formula. For the ending step, we multiply the calculated variance by 250 to obtain the yearly variance of our portfolio. Then, took the square root of the yearly variance to get the portfolio's yearly standard deviation, or the so-called yearly total risk. And finally, our portfolio beta coefficient is a weighted average of the betas of the 5 individual securities in the portfolio. Now, the result for the portfolio's return and risk. Our portfolio expected yearly return is 19.71%, which is much higher than the majority of the individual stocks from both the watch list and as well as the portfolio, and even about 2.5 times more than that of the whole Vietnamese stock market at 19.71% versus 7.71%. Our portfolio EYR could view that considerable return as the stock equity, which is the dominantly high EYR at 28.69% within the basis of its 2017 to 2022 price data. The portfolio standard deviation at 19.53% is less than that of the weighted average of the standard deviation total risk of portfolio separate security, which is 31.19%. Additionally, our portfolio's total risk is even slightly lower than that of the Vietnamese stock market at 19.8%. which would offer a firm security for investors. This result is thanks to the diversification effect, wherein the investor witnesses a lower risk when diversifying his or her investment among various securities, rather than relying on sole investment. Specifically, the investors now only experiences the relative combination of portions from the risk of individual securities.
Yes, and here is the beta analysis. First, I will start with portfolio and market. In this report, we only measure and analyze securities in Ho Chi Minh City Stock Exchange from within the period of 5 years between 2017 and 2022. Therefore, the return of VN Index is counted as the market return and the standard of our beta analysis. When it comes to our portfolio beta coefficient, it is the weighted sum of the chosen 5 stock tickers, in which gives us the figure of beta equals 0.83. This indicates that the portfolio is relatively less volatile than the market. For instance, if a bull market is registered at a scale of 100 points, the portfolio will follow with an uptrend at 83 points.
Thus, we can conclude that our portfolio is best fit for the taste of the play-safe investor due to the stability of its return. And first, I will start with the VIC. The beta coefficient of Vingroup stock stood at 0.86. This is particularly attributed to the characteristic of a conglomerate. Admittedly, this seems to not to be a favorable condition for the shareholder of this company, since the Vietnam economy is facing impact from the Ukraine war as well as the stagflation being projected. However, in the long term, come the economic recoveries, this security will be profitable business for the long-term investor. Second is equity. Equities better observed in the period was slightly lower than that of VIC at 0.73. As can be seen in the 4.0 industry revolution, equity is considered one of the leaders of the Vietnamese economy in terms of technology and advancement. Therefore, it is easy to understand that although the volatility of the firm stock is not as much as the market, it may react accordingly to the economy. VCB. When it comes to Vietcombank, the beta coefficient of this stock ticker is the closer to the market return in the portfolio at 1.07. Therefore, it is believed that this stock return will move more or less similar to that of VN Index. This can be attributed to the fact that Vietcombank is one of the 4 biggest banks in Vietnam, and banking is already known for being highly related to the stock market and the economy. Next is MB Bank. Another stock ticker from the banking industry, MBB, would register the beta in the period from 2017 to 2022 at 1.28, the highest in the portfolio. Because MB Bank is a peer company of VCB in the banking sector, it is also affected by similar factors from the characteristic of a bank, the stock market, and the economy. And finally is HPG. The 5th stock ticker in this portfolio of our team is HPG with a beta of 0.18, one of the major company in the construction material industry and cultivating impressive growth in the COVID-19 pandemic as well. The beta figure tells us that HPG is not very reactive to the change of the market and does not behave accordingly to the VN Index. And that's mine.
For now, I'll be presenting how our team managed to figure out the minimum risk portfolio. In the aforementioned scenario, it is assumed that all the 5 stocks in portfolio are equally invested. But in this case, our team has made use of a handy tool, Excel solver, to figure out the exact ways for each stock among the 5 that would minimize the total risk of our portfolio to the optimal level. Initially, it is ensured that all the functions have been inserted into the cells of the resulting portfolio's total risk or the yearly standard deviations, and the sum of always to be exactly 100%. Then the solver tool from the data toolbar would come into use. In the Excel solver interface, we would first insert the resulting portfolio's total risk in the set objective sections and click the min box. Also, we put the range containing the weights of our portfolio stocks in the My Changing Variable Cells box. Then constraints are added to the variables. The first condition is that the weight of each stock is greater than or equal to 0%. The second condition, the sum of the 5 portfolio stock weights is 100%. For the final actions, we click the solve button and all the results will be calculated and displayed instantly. Regarding the result of our portfolio's minimum risk attainment, the weight distribution would yield the optimally lowest total risk or the yearly standard deviation for the investment portfolio at 18.39% and a healthier beta coefficients of 0.68. So what are logical rationales for this result? First, theoretically, total risk equals systematic risk and unsystematic risk, wherein the systematic risks are uncontrollable in nature and they arise out of external macro factors like politics or economics, and hence cannot be minimized and controlled by the organizational management. Therefore, if a stock has low beta or low systematic risk, it will be less susceptible to the changes from the macro environment. In other words, getting more control of its risk and leading to sustainable stability and less risk for the whole portfolio. The above principles would explain why although VIC expected yearly return is less than that of MBB, but due to its much lower systematic risk, it will witness a 27.3% weight, and MBB would experience 0.1% weight for being over susceptible to the market changes, which could unfavorably impact the portfolio optimal risk. Hence, FPT and HPG with outstanding high EYR and considerably low beta within the portfolio would enjoy great shares in weight at 30.2% and 26.4% respectively. These 2 stocks would play a major role in contributing to the optimal minimum total risk. For VCB, profitable as it is at 18.49% for the expected yearly return, is significant high beta of 1.07 would account for the market share in the weight of 16.1%. Okay, that's it on my part. These are the references for our investment portfolio. And thank you so much for your attention to our investment portfolio. For further questions or queries, please contact via this address. Thank you.